Good morning, everybody. Good morning, everybody, and welcome to the Fonti International. Right ahead of the opening bell, futures little change actually ahead of this long weekend. The Dow is off by 0.3%, S&P 500 0.26% in the red, and Nasdaq Composite 0.17 below the flat line. Very quick look also at European bourses, which are pretty cautious on this last trading session for June. And of course, last trading session for June and the quarter. The DAX is up by 0.25%, the CAC around 0.33% below the flat line, and the FTSE MIP off by 0.5%. FTSE 100 on the other hand is 0.82% in the red territory. Very quick look also at the Treasury. So far the 10-year is pretty flat ahead of the Powell's testimony. Actually, that is certainly extremely important. That may shine a light on what's going on with the U.S. economy. The 10-year is yielding 0.62, the 2-year 0.15, and the 3-month 0.15. In terms of European treasuries and European bonds, so far the spread between the 10-year Italian BTP and the German Bund is 173 basis points, as we can see, narrowing by almost 2%, or more precisely 1.73%. Very quick look also at the Forex. So far the DXY 97.75 up by 0.3%, and euro dollar 1.11, sterling against the dollar 1.22, as we can see, lower today by 0.2%. Certainly we're gonna discuss the markets and everything going on over there, but first of all I want to start with this major story coming actually from China. The top decision-making body in China's parliament has passed a contentious national security law for Hong Kong's, according to a member of the Standing Committee of China's National People's Congress. Tam Yu-chung, the sole Hong Kong delegate to the committee, confirmed that a law was passed. Reuters cited Global TV as saying the law was passed unanimously. It came one day before the anniversary marking Hong Kong's handover from the UK to mainland China on July 1st, 1997. Few details about the law have been unveiled, but Beijing says the legislation is aimed at prohibiting secession, subversion of state power, terrorism activities, and foreign interference. It was proposed during China's annual parliamentary meeting in late May and reignited protest in Hong Kong over fears that the city's freedoms would be eroded. A China State Council Information Office said in a media briefing on the legislation will be held in Beijing at 10 a.m. on Wednesday, which is going to be, of course, tomorrow. So certainly it's going to be very interesting to figure out a few details. Actually, Hong Kong Chief Carrie Lam said that she doesn't know any details, and certainly something very interesting to me is that following reports of the law had been passed, prominent Hong Kong activist Joshua Wong announced that he would be stepping down as Secretary General of Pro-Democracy Party Demosisto. Certainly this is a major blow to the Hong Kong activists and a big disappointment. Certainly we're going to discuss about this topic a little more on the show. But first of all, let me bring my first guest on the show, Michael Roche, fixed income strategist, Seaport Global. Good morning, Michael, and thank you so much for being with us.
It's a pleasure, Alex. Good morning.
Mike, I want to kick off with this major story because certainly it's important also for the U.S., for the performance of Hong Kong, which has been a major financial hub in the past few decades. Do you believe this is going to have a negative impact in terms of performance of the so far autonomous city?
Well, yes, Alex. You may know that I worked in Hong Kong for almost a decade, ending in 1998. So I've been out of the city-state for quite a while. But at that time, at the handover time, the more negative, the people who were negative towards the future thought there would be a creeping control by the Chinese Communist Party of Hong Kong, and that in the end, Hong Kong would become, as they would say, just another Chinese city. And so, unfortunately, that appears to be the case with this national security law, in that if this is the first of a number of interventions into the affairs of Hong Kong, then capital that's there by choice in the financial sector will seek to go elsewhere. What Hong Kong will lose its international financial center status and become the center for China financing. Also, when I was living in Hong Kong, the Chinese wanted to leave Hong Kong alone for a while because they would learn the capital markets and financing methods and currency market methods and policies from Hong Kong. And now, 20 years plus on, those are well known now. And as a matter of fact, as the China's Communist Party is clamping down on Hong Kong, they are opening up China's domestic capital markets and financial markets to foreign investors and foreign banks and foreign intermediaries. And so the need for a Hong Kong special status has been reduced in the eyes of the Communist Party. I suspect that it could be the case that they just end this as a political matter. It's a matter of political control, and so this lower degree of freedom, may not have a big material change. But I would suggest that for Hong Kong people, the continuation of the so-called brain drain from Hong Kong, people emigrating to U.S., U.K., Australia, other destinations will continue. And for the more negative-minded observers and political scientists and the like, this puts a worry now, of course, on Taiwan in its remaining independence, because this move by the Chinese Communist Party on Hong Kong will put concern by the leaders of Taiwan to protect their state of independence from the country. And of course, the Chinese Communist Party strongly desires to keep to retain and in fact change the status of Taiwan back into a province of the People's Republic. So net, it's certainly a negative for the dynamicism of Hong Kong. I would suggest from a practical investing point of view, the banks and property companies and the like will trade on lower multiples. Just their ability to rally strongly and trade at stretch multiples, I suggest would be off the cards in the immediate future, and likewise credit spreads for Hong Kong domiciled and Hong Kong exposed corporate credits.
Certainly the situation is pretty interesting. Also, you've mentioned the dynamics with Taiwan. And of course, I just wanted to add the dynamics between China and India, which are also getting very interesting. And of course, there is a new dispute between the two countries. Anyway, I want to move to the treasuries, because situation over there is also extremely interesting. Of course, the treasury yields are steady, as we can see, before Federal Reserve Chairman Jerome Powell's testimony to address the central bank's response to the coronavirus pandemic. In remarks prepared for a congressional hearing, Powell said that despite a recent uptick in economic activity as lockdown measures are eased across the world's largest economy, the outlook is extraordinarily uncertain and will rely on both containing the virus and government support for the recovery. Mike, I was wondering, we do see extremely low treasury yields. Are we going to remain with these current levels in the medium to long term?
Well, by by the Fed's own declarations, yes, we will. We're certainly, this economy here is certainly far from at its full capacity. What inflation would persist here is mostly from food shortages, for example, arising from supply constraints due to the coronavirus outbreaks at processing centers for protein and things of that sort. Otherwise, the notion that inflation would be a worry in the medium term is just not present, and with the Fed's open market purchases and expansion of its balance sheet, you would suggest that yields are just here to stay at very, very low levels. In fact, the behavior we're seeing by market participants is to center investments in is to have such confidence of this. They are the weight of funds invested in the Treasury market are moving outwards from 2-year. The more safety-minded are moving outwards from, say, 2-year notes now to 5-year notes, and that the betting on changes in yield curve and any kind of inflation estimates is taking place in the so-called yield curve spread between 5-year bonds and 30 years. So as we go forward, and each and every month we do not see the inflation arising and the Fed continuing to support the Treasury market, that confidence that lower rates are here for the medium to long term will just strengthen.
In fact, it's pretty interesting, the situation also with the inflation. I was wondering, how would you assess the Fed movements in the past few months? We saw very recently easing the Volcker rule. On the other hand, they capped banks' dividends and not only suspended buybacks, which is certainly a major warning. How would you assess their movements? Did they do a good job in your opinion?
Well, I must say, Alex, I've been in the financial markets now for nearly 40 years, and from the context of a young man trading on Wall Street back in the 1980s, where the government's involvement in these matters was very, very light, almost virtually none. The Fed's balance sheet, for example, back then was not about $500 billion, not even, and now it's at $7 trillion. And the idea of having banks, having the regulatory strength to command policy, a bit of dividend policy on banks, perhaps even in their bonus and management pay and share buyback considerations was unheard of. So we've all gotten used to this. It's a fact of life in the need to control or exert incentives to keep capital corralled in the banking system and not to leak into, say, foreign markets or into just into bank deposits. So I think they thus far the system is not broken. We have a strong banking system in the United States here now in terms of capital, capital held, in terms of the volatility of banks' balance sheets, their assets and the like is historically low, and so from that perspective, the Fed has been successful, and it's just come at a historically, a departure from the historical practice here in the United States of the government entering very infrequently to smooth, say, market upset or to right malpractice, and then with penalties, and then retreat to being observers and light regulators. That's now, I think, just in the past. We're clearly in a very highly regulated and highly interventionist regime now, and that's going to also be the case for the foreseeable future.
All right. Thank you very much. Michael Roche, Fixed Income Strategist, Seaport Global. Thank you for joining us. Have a great day ahead.
Thanks, Alex. You too. Bye for now.
Well, before we go ahead with our next guest, I wanted to show you very quickly Uber because it's making major stories once again. Certainly, it's been a pretty interesting moment for the stock. This is, of course, the yesterday's closure 0.07% above the flat line, but so far in pre-market is almost 5% higher. Uber Technologies is in discussions to buy Postmates for about $2.6 billion, according to people familiar with the matter. The latest in a rapid-fire series of moves to consolidate the food delivery industry. Should a deal come together, it would be announced next week, if not sooner, but there is no guarantee it will. Postmates, which has held discussions with other possible buyers since at least last year, has been simultaneously planning an initial public offering. Just Monday, people familiar with the matter said the closely held metal delivery startup was preparing in the coming days to make its IPO filing public, which could presage a trading debut later this summer. Certainly, we're going to follow the situation because the how can I say, the marriage between Uber and Grubhub didn't happen. So let's see if this one is going to happen. Certainly, the industry, the sector is facing a lot of consolidation, especially around the coronavirus. I want to show you very quickly also the banking sector. It's going to be a major market mover today. We're going to hear from Powell and, of course, together with the Treasury Secretary Steven Mnuchin ahead of the Congress. Shares of Wells Fargo are higher by 1.2% in pre-market. Of course, after the bank said it would likely slash its dividend in the third quarter to comply with a Federal Reserve stress test. Bank of America, Citi, JP Morgan, Goldman Sachs said their dividends would stay the same. So this is certainly important. Wells Fargo so far is going to be the only one to slash dividends for the third quarter. Instead, JP Morgan, Citigroup, and Bank of America are going to pay the dividends as they were previously. I want to bring to the show my next guest today, Peter Cardillo, Chief Economist, Spartan Capital Securities. Good morning, Peter, and thank you so much for joining us.
Thank you for having me.
Peter, we saw many swings, and at the end yesterday, right ahead of the closing bell, we did see a lot of green on the board, especially regarding S&P 500 and the Dow, which deleted all the losses, erased all the losses for June. How do you explain these swings, and what do you expect from this last trading session for the month?
Well, there's no doubt that we're going to close a very strong quarter. And of course, we had huge losses and then we recovered. And it's probably the best recovery, or the best quarter, I should say, that we've seen in over 20 years. So it's all basically based on hopes and the fact that, we're beginning to see some macro news that is quite encouraging. As far as today is concerned, I suspect we'll close somewhat mixed, maybe a little bit higher. We have some macro news that we'll be looking at today, and the key will be consumers' confidence. We're looking at a reading of about 88, which would be slightly higher and basically holding steady, and that's key. If we see consumers continuing to hold the line and not beginning to worry about the prospects of the economy in the longer run, then I think that's good news, because that means you'll have spending continuing to improve, and obviously that's the key for a successful recovery. Also, we have Powell and
Yes.
Secretary of the Treasury Mnuchin testifying before the Financial Committee at 12:30 this afternoon. And I suspect that we're going to get a fairly rosy outlook. They're obviously going to be testifying on the results of the pandemic, but during the Q&A, obviously, I think we'll get a rosy picture from Mnuchin and probably a less rosier outlook from Powell, more or less a more subdued outlook. In fact, he'll probably stress once again that there are still a huge amount of unemployed people here in the United States, and that's the key for a robust economy.
In fact, in remarks prepared for a congressional hearing today, Powell said that despite recent uptick in economic activity as lockdown measures are eased across the world's largest economy, the outlook is extraordinarily uncertain and will rely on both containing the virus and government support for the recovery. So how do you interpret these words? Because he's always very cautious and extremely worried and wary about the U.S. economy.
Well, I think that's one of the reasons why we could see a mixed close to the quarter today. But again, it's been a very strong quarter. So, even if we were to go down on the day, or if we would add to yesterday's gains, it wouldn't be that meaningful. We're at the end of the quarter. The key is, what do we do in the third quarter? And I suspect probably a very narrow trading range until we get until we get more evidence that the economy is finally recovering, and that we could be out of the recession maybe in the beginning of the fourth quarter of this year. If that becomes questionable, then we could even see a pullback in the market.
How preoccupied are you about this actual second wave of coronavirus cases in the U.S.?
Well, here in New York City, it certainly seems to be, in New York State, I should say, it seems to be under control. And in many states in the United States, it's under control. There are states that have spiked up tremendously over the past 3 or 4 days. Florida is one of them. California, another one. And so it's an iffy question, but the fact is that the Trump administration has made it very clear that they're not going to shut down the economy again. So it's a problem, and it all depends, what happens in California and in Florida. Remember, those are two big states that contribute a lot to GDP.
Of course, that's for sure. I was wondering, what is your take on this phrase? U.S. policymakers could change the world by devaluing the dollar. Speaking in an interview for American TV channel Independent Macro Advisor Hugh Henry said quantitative easing programs where central banks buy assets like government bonds to inject liquidity into the economy were not working. This is pretty courageous statement. Do you agree with this?
I don't agree with devaluing the dollar. I don't think that would work. And I'm not sure, if tampering with the dollar would make a lot of sense. If you have a devaluation of the U.S. dollar with the tremendous amount of deficits that we have, that would not work. It'd probably backfire, and that certainly could eat up inflation. And that would mean that they would have to combat inflation and not necessarily deflation. So I don't subscribe to that. I think the market needs to take its course, and I think that the dollar will probably just hang around these levels. Now, that doesn't mean it can't slip, a bit more, but I don't think that it's going to, fall out of bed. And I don't think that the administration would even think to devalue the dollar.
All right, and then do you believe a lower dollar index might have very negative impact to the other currencies, especially the emerging markets ones?
Could you repeat that, please?
Do you believe lower dollar index might have a major impact from a negative point of view, of course, on the other emerging market currencies, and not only, of course, also the euro and the sterling?
Of course, it would push up the euro. It certainly, uh, probably even push up the Chinese yuan and, I'm sorry, lower the Chinese yuan, and it could cause some havoc for the emerging market currencies. And that would be a destabilization of the foreign exchange market. So I don't think it's to the best interest in doing that. And by the way, if the US dollar were to get devalued, you could see the price of gold shoot up above $2,000.
All right. Thank you very much. Peter Cardillo, Chief Economist, Spartan Capital Securities. Thank you for being with us.
Thank you for having me.
Well, we're heading for a very quick commercial break. Stick around, guys, because we're going to talk about the energy sector, and of course, we're going to analyze the last trading session for the month. Welcome back, everybody. The Dow is sliding more than 100 points so far, 0.4% lower. S&P 500 is off by 0.26%, and Nasdaq Composite 0.23% in the red territory. Of course, those are the futures last trading session for June, so certainly it's going to be extremely interesting to see how it's going to end. On the other hand, we do see that also European stocks are rather in the red territory. The DAX is off by 0.01%, the CAC around 0.42%, and the Italian FTSE MIB off by 0.7%. So certainly a lot of steam is over, and stocks are trading below the flat line. I want to remind everyone that today we're going to hear from, of course, Treasury Secretary Steven Mnuchin and Jerome Powell that are going to most likely shine a light on the U.S. economy, and we're going to have a little bit more details on what's going on. Now let's talk about the WHO, because it sent a major warning yesterday. The coronavirus pandemic is accelerating around the world as many countries that reopened their economies see a resurgence in COVID-19 cases. Tedros Adhanom Ghebreyesus, Director General of the World Health Organization, said yesterday, although many countries have made some progress globally, the pandemic is actually speeding up. He said during a virtual news conference from the agency's Geneva headquarters, "We all want this to be over. We all want to get on with our lives, but a hard reality is that this is not even close to being over." The virus has infected more than 10.1 million people around the world and killed more than 500,000 people so far, according to data compiled by Johns Hopkins University. More than 60% of daily new cases came from countries in the Americas, of course, according to the data published by the WHO. So certainly the situation is not positive in terms of coronavirus in Latin America and a few U.S. states like Texas, Arizona, Florida, and of course India and Brazil, where situation is pretty complex. Anyway, I want to move to the energy sector. As I told you, we are going to analyze the energy sector. First of all, I want to kick off with a stock to watch, and this is Royal Dutch Shell. So far, 0.5% higher. Oil giant Royal Dutch Shell said it will write down the value of its assets by up to $22 billion in the second quarter after revising down its long-term outlook for oil and gas prices. It comes after the energy company announced in mid-April an ambition to reduce greenhouse gas emissions to net zero by 2050. Shell said in a statement to investors that it had reviewed a significant portion of its business given the impact of the coronavirus and of course pandemic and the ongoing challenging commodity price environment. I want to show you very quickly, except from Royal Dutch Shell, which is 0.55% higher, very quick look also at a crude oil price. So far WTI is trading $39 per barrel, off by 1.5%, and the Brent 1.15% lower, but still hovering around $40 to $41 per barrel. So situation over there is also pretty interesting. A lot of swings, but not too big as what we saw more or less 1 month ago. Anyway, in order to analyze the sector, I want to bring to the show Andy Lipold, President Lipold Oil Associates. Good morning, Andy, and thank you so much for joining us.
Good morning. Thank you for having me.
Andy, before we kick off with analyzing the sectors, I was wondering how much of a worry is for you the fact that coronavirus cases in the U.S. are surging, specifically in Texas, Arizona, and Florida. Could this be a problem for the crude oil price?
Well, certainly it is a big concern, and it will be a problem for the crude oil price, because what you're seeing is these state governments are backing off on their reopening, and of course that means there's going to be less demand for gasoline as people go out to work or they're going out for recreation. So it is a big concern. We've already seen that gasoline demand here in Texas has dipped over the last couple of weeks. And of course, this is going to continue to put some pressure on crude oil prices.
What kind of price range do you imagine in the medium to long term? Of course, I'm mostly, how can I say, focusing on the medium, because you know it's very difficult to analyze the long term because there are many factors to watch.
Well, sure, but in the near term, we've seen oil prices stuck in a range between $40 and $42 a barrel, both for WTI and for Brent. And of course, on the one hand, we have economies around the world that have been reopening, the European Union, India, China, as well as now Mexico and South America and Brazil. So that tends to support the crude oil price. On the other hand, there's this concern about a second wave of virus around the world that would result in oil prices and oil demand going down. But by the end of the year, I actually expect that Brent crude oil prices would reach $50 a barrel, as OPEC Plus has been doing a very good job, and they're determined to rein in the oversupply of production, since they don't want to see a repeat of oil prices going below $10 a barrel that we saw earlier this year.
Which is the most important factor in your opinion? What are you observing? What are you looking at?
Well, what I look for crude oil price signals is a few things. One is, what is world oil inventory doing? And to the extent that world oil inventory for both crude oil and refined products continues to decline, then OPEC Plus feels that they have the situation under control. On the other hand, I'm also watching the Baker Hughes rig count over here in the U.S., which hit another record low on Friday of 265 oil and gas rigs. And what this means is that even at these prices, the profitability of drilling brand new oil wells is negative. So we're going to see a constraint on new oil production coming out of the U.S.
Right now, you believe is more important China or the US for the sector, because China is a major importer, probably the most important worldwide. We do see some positive macro data coming from China, a lot of optimism over there. So I was wondering, what's the outlook in terms of China?
Well, both the U.S. and China are very important for oil demand. Now, in China, of course, we've seen a recovery in the oil demand, and that's been good for the oil market. They have been importing record amounts of crude oil to process in their new refineries, of which they've brought on 3 new grassroots refineries over the last 12 months. So at the same time that they're importing crude oil, we see them exporting refined products. What is a concern is when you see an outbreak of the coronavirus in Beijing, and then certain neighborhoods are getting locked down. And of course, that impacts on ultimately the jet fuel demand. So that is the concern over there. Here in the U.S., we're in the midst of reopening the economy, and we have seen gasoline and diesel demand recover. The concern is that, are we going to now take a couple of steps backward, and that results in more pressure on oil prices as demand slows down.
Andy, a lot of shale oil companies are filing for bankruptcy. Yesterday, the last one we saw is Chesapeake. So certainly it's a tough moment, specifically for the shale oil producers. I'm not talking about a giant. So far, the USO, or the United States Oil Fund, is 1.31% lower in pre-market, and the XOP, which is the S&P 500 oil and gas CDF, is 0.28% higher. Of course, once again, I'm talking about pre-market. When do you expect the shale oil companies and producers to be back on track as they were in pre-COVID times?
Well, I think that all depends on the oil price, and unfortunately for the shale oil producers, that's probably 18 months away for a recovery of oil prices. Even if Brent got to $50 a barrel, that is not high enough to really encourage new oil drilling. And given the amount of debt and bankruptcies and consolidation that we have seen and will see in the oil patch, it's going to take some time to sort out all of these financial arrangements. And I would say that private equity right now is very reluctant to sink more money into the Permian Basin and other shale producing areas, because they just simply haven't gotten the returns over the last few years.
All right. Thank you very much. Andy Lippold, President, Lippold Oil Associates. Thank you so much for joining us. Have a great day ahead.
Thank you very much.
Well, let's get to the stocks. I just want to have a very quick check-in on what's going on over there in terms of futures. The Dow is off by 130 points, 0.50% lower. S&P 500 is pointing also lower, opening 0.36%, and Nasdaq Composite 0.28% in the red territory. Certainly, the stocks to watch are the banking stocks. I want to show you very quickly the index. Here it is, the KBE index so far in pre-market 0.1% higher. Shares of Wells Fargo ticked 1.2% lower in pre-market after the bank said Monday it would likely slash its dividend in the third quarter to comply with a Federal Reserve stress test. Bank of America, Citi, JP Morgan, and Goldman Sachs said their dividends would stay the same. Shares of Micron jumped 5.3% following the company's better than expected earnings report. Micron gave strong forward revenue guidance. Shares Lululemon gained 4% on news it will acquire at-home fitness company Mirror for $500 million. So certainly it's going to be extremely interesting trading session, the last one for June. So certainly investors and traders are going to try to pull out profits. Anyway, let me bring to the show my next guest today, Jean Erga, Chief Economist, Tigris Financial Partners. Good morning, Jean, and thank you so much for joining us.
Good morning, Alexandra. Always a very great honor. Thank you.
Jean, it's a big day ahead of us because we're going to hear from Steven Mnuchin and of course Jay Powell. Jay Powell certainly is going to be very cautious because in a note yesterday evening here and of course afternoon in the US, the Fed and of course Powell said that he's extremely preoccupied about the long term in terms of macroeconomic performance. So first of all, I wanted to ask you what do you expect from this last trading session? And do you believe, of course, futures are pointing lower opening? Are we going to remain like that?
Yes, I think we're going to have a very cautious session. I think people are going to be squaring positions. There is always, of course, the rebalancing, which is as distinct from the traders who have made money, who say, I take the money and run Woody Allen economics. There's also the rebalancing of the very large institutions who say, well, look, I mean, I have to have a certain proportion between fixed income bonds, fixed income stocks, and possibly other assets. And I do this every 3 months. And this is the day upon which I shall do it. But we have seen relatively little of that. I mean, there was a huge forecast. There was a forecast we're going to have this huge wave of billions and billions of dollars hitting the market and causing very sharp falls. And hitherto, we have not seen this, which maybe leads us to believe that some of them, in fact, are still under allocated to the market. And therefore, the weight of money argument in terms of cash on the sides might still have some substance, assuming that the conditions are appropriate for further investment. I think this is the first point. The second point is that investors, be they retail investors or the big money institutional investors, are also looking, obviously, at the situation with the virus in the world. And I say the world as distinct from strictly the United States or their own national confines. There's been a lot of focus on what is happening in Arizona, but we're starting to see people focus also on what's happening in Brazil and other countries as well, and in the UK, and wondering, are they really coming out of it? I mean, or are they coming out of it only economically? To what extent are the economics of governments or political economy of governments forcing them to, A, so to speak, massage the data and present it in an otherwise more flattering light, and B, take action? So I think this is very, very important. I mean, to what extent have political actions towards reopening superseded facts on the ground with relevance to the medical spread or into the contagion? So I think people are looking at that. 3, I believe that there's going to be great interest in the Mnuchin-Powell appearance, and the question will be this, will Mnuchin and Powell actually play tennis as doubles partners and present the same case? Or will there be a split between the economic vision and the political vision? Powell enshrines the economic vision. We read the pre-prepared comments. They were not cheerful. I can assure you, if there's any of the stiff drink, if I drank, I would have had a double whiskey after this. He talks about the very great uncertainty surrounding the economic recovery and the permanent structural damage, which I think is absolutely correct. On the other hand, Mnuchin is saying we don't really need all these very big measures because guess what? Things are on the mend already, and we're getting going forward. So will they actually be able to unite, or will they not? Or will it be to, let's put this way, discordant views presented to the House Financial Services Committee? But certainly Powell will insist that the government continue to do its bit.
you know, they generally are not united. I mean, they generally have a very different opinions on both the economy and the administration so far. I wanted to touch on the treasury yields, pretty flat, actually steady ahead of the Powell's testimony. Do you believe this is the new normal? Because we were used to see, you know, the 10-year at least 1.8 in terms of yields.
Well, I think basically we're now seeing the 10-year collapse. I mean, the 10-year has moved from 0.7 very quickly to 0.63. Now you will say, and many will say, what are 7 basis points? This is noise. No, this is signal, because we're pushing up, down, we're getting down to the 0.5 level, which is the level at which things become extremely serious in this country, because basically the fixed income market is shifting its view from slow recovery to basically the state of permanent recession. So I think it's very important where we are now in terms of the fixed income market. 5-year, for a very simple reason that we're touching record lows there as well. Now, what is this due to? This is due to the fact that markets anticipate or see the need for and anticipate further, let's put it this way, Federal Reserve muscular action. Now, what can the Federal Reserve do? Now, this really leads us to the whole yield curve targeting argument. They say, well, look, they can target the 5-year. All right, they can target the 5-year, they'll push that down. But the question really becomes, why do you need to target the 5-year, and what are you trying to get at? And so I'm starting to think that basically this discussion, at least as to yield curve targeting and the 5-year falling concomitantly, is nothing more than a type of corner shot, as they say in soccer, for the Federal Reserve to really edge down to uncertain securities to negative rates without actually having to implement this policy formally. They're going to talk the rates down. The yield curve targeting is not something which is to be implemented. It is something which is far more powerful talked about than done. So I think keep watching that, because that's very interesting as well. And we've got a 2-year bond yield, which I think is de facto, once you strip out the noise of daily fluctuations, is actually 0. So the yields are falling, and they will continue to fall. I don't see the yields going up anytime soon.
Well, that's pretty interesting. I wanted to talk about a statement that was extremely interesting to me. I'm just going to quote the man. U.S. policymakers could change the world by devaluing the dollar. Of course, those are words of Hugh Hendry, who is independent macro advisor, who also said that the quantitative easing programs where central banks buy assets like government bonds to inject liquidity into the economy were not working. That's a pretty strong statement. Everyone is talking about it. Do you agree with that?
Oh, that the QE did not work? Yes, absolutely. No, absolutely. I mean, the QE did absolutely nothing for the real economy in the United States. It did a lot for the stock market. It did a lot for wealthy people who had assets of some kind, who were going to benefit from very low interest rates, for example, through revaluation of housing or housing pulling out of a very difficult position, stock portfolios, for example, capacity to borrow against this equity unrealized in their house and then spend, but it absolutely very little to boost consumption at any kind of, let's put it this way, the other 80% level. No, I think that was an absolute failure economically, and it got us absolutely nowhere. What actually got the country somewhere with most probably very serious consequences for our fiscal balance were the tax cuts brought in by Trump, and also the deregulation, which opened the door to hiring by small companies. So I think absolutely right. I think basically this monetary tinkering has had an effect at the financial level, but has rarely been able to jolt the real economy into some type of, let us put it this way, higher gear.
And what about a DXY?
On the dollar index, okay, look, where do I see the dollar? The dollar, I see it remaining relatively strong. The dollar's demise has been predicted, I don't know how many times over at this point. I mean, I'm 65, turning 65 in August, and quite frankly, I've been hearing this since I think I was about 7, that the dollar was on the verge of collapse, that the dollar was yesterday's news. The dollar is not yesterday's news. The dollar is still extremely strong. We still see a strong bid for the dollar, based on 2 things. First, it remains the world's single largest economy, and the focus of investors is on it. And we can see this very simply by the fact that 10,000 plus cases in Arizona or in California count for more than 1 million unfortunates in Brazil. There is a reason people are focusing on what is happening in certain US states. Secondly, it is one system, It is a uniform economy. It is a uniform legal system with very minor exceptions. And quite frankly, it is the world's leading defense power and strategic power. So I think the dollar will always have a strong bid. This idea that the dollar is going to collapse, that the dollar is subject to forces which are purely economic, this way, or based on commercial flows, is completely false. You can have this view, for example, of the euro. You can have this view of the British pound or other excellent currencies. But the dollar is not, so to speak, swayed exclusively by economics, but by longer-term strategic and political considerations.
Jean, I want to talk about the dynamics in Hong Kong, because certainly we saw that the top decision-making body in China's parliament has passed a contentious national security law for Hong Kong, according to a member of the Standing Committee of China's National People's Congress. Unfortunately, there are not many details regarding the law, but of course it's going to try to stop, of course, all the activists. So I was wondering, what's your take on that? Certainly tomorrow, I believe at 10 a.m. on Wednesday, Beijing time, we're going to hear from the Chinese Communist Party more details regarding the law. What's your take?
My take is extremely simple. We don't need the details. I mean, this is simply what in 1938 with Austria. I'm sorry. I mean, maybe the privilege of age and saying what I think, I mean, is getting the upper hand here. But it's quite simple. I mean, this is Anschluss. This is union. I mean, it is that simple. It is saying, listen, I mean, you are going to be subject to the same basic laws as we are. And the basic law is not so much the law, for example, on traffic offenses. It is the extent to which we can curtail your freedom, because that is the basic law. And it's that simple. And here, under this law, from little I've read about it, I mean, I need to read much more. Any kind of sort of anti-government activity can be punished. You go and tell me what anti-government activity is. This was the famous Article 58B in the code of the legal code under Stalin in the Soviet Union, which sent millions and millions of people to the Gulag. Article 58B, counter-revolutionary activity. It can be absolutely anything. And it's going to give them tremendous leeway. So I think this is a very bad day for civil rights, very bad day for Hong Kong. And I think it's going to have more impact than people actually think. And I think that the next one is not going to be, so to speak, simply putting this law through, but they will be geographical. It will be increased pressure on Taiwan. Because basically, what underlies all this, underpins all this, is a unification in the very broad sense of the word.
Yeah, in fact, also the dynamics with Taiwan are extremely interesting, but also, so to speak, the China and India dynamics are going to be extremely interesting, because there are conflicts over there. How do you explain the fact that Hang Seng closed 0.52% higher despite this announcement?
No, I think it's going to be this announcement, and this announcement must be distinguished, for example, from, let us put it this way, what's actually happening on the economic front in the short term. These companies are not going to go away tomorrow. They're not going to vanish. There's still going to be very strong interest, for example, on the part of mainland investors operating directly from the mainland or from other centers in the Hong Kong market. I mean, it's that simple. I mean, it doesn't mean that things are going to change economically from one day to the next or financially. But over the longer term, we can be quite sure that if these laws are implemented, there will be less of an appetite for certain financial institutions to either keep a large presence or expand the presence they have. It is not going to be from one day to the next. We are not talking about nationalization here. It is not that the government is marching in like Nasser in 1960 and 61 in Egypt and saying any company with more than 15 employees, is now going to revert to the state. No, this is not it at all. We will keep the private sector there. On the other hand, what is far more important for the longer term will be the constraints on any kind of political activity and being able to challenge any measures taken. I mean, the money is all still there. I mean, in Nazi Germany, the stock market was quite strong. I mean, it sounds grim, but this is the way it is.
But in terms of foreign investments, for example, also U.S. investors, do you believe there is going to be an important decrease, which is also going to have a major impact on the GDP, of course, in the future, a money flow?
The GDP of who, basically? Whose GDP? Are we talking about the GDP of Hong Kong, the GDP of the United States? Yes, I think that obviously there are going to be certain financial institutions in the U.S. which will not want to build out their presence there any further. That is absolutely true. I do not believe they're all going to get up and leave. This is very simple, because the point is basically this. U.S. and China are going to continue their relations. They are not going to break. This is not going to be a break situation where they withdraw or recall their ambassadors. Let's be very straight about what is actually going on here. Trade is booming. It is booming to the point where now, in fact, to sort of, let's put it this way, sort of supersede or mitigate supply chain blockages, U.S. companies are hiring or looking for super fast boats to ferry the boats from China to the U.S. I mean, it's hardly sort of a continental blockade that's taking place. But I do believe that over time, two things will happen. The presence of certain financial institutions in Hong Kong, for what it counts, will diminish or will certainly not increase. They will put their capital elsewhere. And two, the point that most people are missing is that China does not need Hong Kong anymore. I mean, it's that simple. I mean, it does not need it to survive. This is not the China of 1985. This is not the China of 1990. This China is very powerful in its own right, has shifted from being an exporter to being a domestic producer and a domestic consumer, has shifted from being an exclusively practical foreign importer of capital from abroad because of lack of domestic savings to being a massive exporter of capital abroad. So I think we're looking at a very different kettle of fish here. I think in the short term, the U.S. needs China much more than China needs the U.S.
All right. Thank you very much. John Urgas, Chief Economist, Tigers Financial Partners. Thank you for joining us. Have a great day ahead.
Thank you very much indeed for having me. Thank you.
Well, guys, last check on the U.S. futures, the Dow is off by 120 points, S&P 500 0.32% lower, and NASDAQ Composite 0.24% in the red territory. We're going to switch our programming to our Italian channel, so stick around, folks, because this is the last trading session for June, and it's going to be a big show ahead of us.